The day of reckoning. Markets cautious as traders await Jerome Powell's final Jackson Hole speech. But rate cut bets are trimmed after hawkish comments from Fed speakers. The EU and US outline plans to cut tariffs on cars, pharmaceuticals and chips within weeks. But there's still no deal on wine and spirits. Plus, Nvidia said to halt production of its made-for-China H20 chip. That's after Beijing warned Chinese companies to avoid them. So market positioning, there is a steady mood here leading up to the speech, of course, from Jay Powell at Jackson Hole. Will he validate the market pricing around September for the first cut of the year, or will he kneecap that view and focus in instead on inflation risks? S&P futures then currently eking out some modest gains after 5 straight days of losses, but it is on a knife edge and it will be dependent on what we hear from the Fed chair, it seems. The benchmark 10-year, we're checking on that, largely unchanged in the session. At the front end, the 2-year at 378, more sensitive, of course, arguably to what we hear from Jay Powell later today. Euro dollar at 115, a little softer on the single currency, down 0.1%. And Brent in focus again, some more ire focused on India from the Trump administration. Unchanged so far in the session at 67 and 69 cents on Brent. Let's flip the board and have a look at how things are shaping up across the map when it comes to the European session. You have the grocers and personal care under pressure as a sector. Chemicals holding on to some modest gains. But again, this is very much a market looking for that direction. The FTSE 100, which broke through fresh records this week, currently a little softer, down 0.1%. Over in France, you're seeing very modest gains on the CAC 40. Slightly brighter picture over in Spain and Italy. The DAX, though, in Germany, a little softer by 0.1%, with German GDP data coming in below expectations for the second quarter. We'll get the analysis now on all things Fed and these markets. Let's get to the show.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and happy Friday. Welcome to The Pulse. I'm Tom McKenzie, standing in for Francine Lacqua this Friday. Central bankers then, of course, and economists gathered at the Federal Reserve's annual Jackson Hole conference amid inflation concerns and growing political pressure on the Fed. Traders will be listening, of course, to Jay Powell's speech for any hint of what policymakers may do at that September meeting.
I don't see any chance that there's a nod toward a September cut or any promise of a September cut.
The caution I would give, if they do move in September, I don't think that's the start of a cycle. I think it's an individual decision. Then they'll wipe the slate clean and take the next 6 weeks, try to understand these cross currents again.
I think they're modestly restrictive. I'm still trying to find ways of what's being inhibited in the economy from where our policy rate is today. But I think we're on a good path.
For sure, it feels to me like it's a live meeting. As you know, before April 2nd, before we got some uncertainties coming on the policy side, I believed that we had pretty stable full employment, that inflation's coming down to target.
OK, let's bring in Bloomberg's Valerie Teitel right now for the market reaction to this and what we've been hearing from Fed officials. And the messaging out of Jackson Hole, so far at least, Val, seems to be modestly hawkish.
Yeah, that's right, Tom. All those Fed officials we heard from in the last 24 hours, none of them seem to have penciled in a September rate cut as a done deal. Many of them talking about how we still need confirmation of the labor market continuing to weaken and progress on inflation before they pencil in a cut in September. That's led to some front-end repricing. We saw yields move higher yesterday across the Treasury curve. The 2-year yield, the very policy-sensitive 2-year yield, rose around 4 basis points in the session, has risen now around 10 basis points since that hot PPI print that we got last week, leading to these bets on the September rate cut to really pare back. You know, it was only last week we were pricing in 100 or so percent of odds for that rate cut on September 17th. It's now all the way down to 75%. So some of that hawkish language really tempting a rethink about what we could hear today. It's also caused some problems with the equity market. Yes, we've had tech have a wobble this week, but we're now have clinched 5 5 straight losses for the broad U.S. equity market. The S&P 500 down for 5 straight sessions, and futures over the last 6 have now lost over 1.5% in that time frame. But where to next really depends on the signal from Powell. Later this afternoon at 3 p.m., a dovish scenario would see him in some way suggesting or expressing concern about the labor market, and that would be the signal that the market would need to pencil in that September cut. On the hawkish side, though, he could talk about more technicalities when it comes to their monetary policy framework. He could drop something called flexible average inflation targeting. So something our own Anna Wong has written about, and something that Nick Timrose over at the Wall Street Journal did as well. If he wants to sound neither, he could just sound as ambiguous as those Fed speakers that we heard from over the last 24 hours. Stress data dependence, stress the fact that we still need to see more labor market evidence, more evidence on CPI before we're penciling in that September decision.
OK, Bloomberg's Valerie Teitel, thank you for breaking it down for us with that preview. Let's get more analysis right now in terms of the market reaction, how to think about positioning around this event and beyond with Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions at Blackrock. Ursula, good morning. Thank you for joining us in the studio. Those 3 scenarios have been outlined then by Valerie Teitel. Where do you think Jay Powell ultimately lands in this speech later today?
It's going to be a very interesting one to watch, I agree with you, because to Valerie's point, there's 3 components here that we need to focus on. The first one is the inflation picture. If we look at going into today, we had a CPI and a PPI reading recently that are somehow divergent or in dissonance. CPI in line with consensus, PPI way hotter. So again, the jury is still out there in terms of how much of the tariff effect has been transmitted. Not much yet. We've seen something in furniture, in electronics, but broadly speaking, is a benign picture, yet is there more to come? And we saw some commentaries around earnings this very week around prices going out by the week. So I think that will be an area within the speech to focus on. Labour market weakening, I'm obviously referring to the latest payroll, but also the 2 prior downwards revisions, which were significant. And so I think there's a picture there where weakening is solidifying as a forward look. And then more recently, yesterday, PMI, a flash PMI that actually was very good. And so painting a picture of economic growth. And so how do you square those 3? I think the main areas to look at within the speech will be these 3 components and how they get combined and messaged. We also need to remember, though, Tom, that there's still over 3 weeks to go between the 16th and 17th of September with a CPI coming out, another payroll. So it will be unlikely for Jay Powell to confirm a clear path, having still missing data on those 2.
Given the mixed picture on the data that you outlined for us there, and the fact that you do have more labour market data and more inflation data coming through before the September decision, does that not make the case for a Jay Powell who later today stresses data dependency and keeps his optionality?
I think that is a very possible scenario, and I think that it's been somehow what investors have been doing in August. So if I read flow numbers and where people are voting with their money, July was a very different picture to what we've seen month to date. July, very much an equity month, 60 billion going into exchange-traded products. US equities seeing a resurgence, including from international investors. The big story this year has been repatriation. 88% of US equity purchases have been done by the US retail investor. And yet in July, we saw European investors buying US equities again to the tune of 4 billion. So that was July. Moving into August, and I think that this connects with, big event risk, such as the one today, we've seen this cautious approach coming in. Yes, the last 5 days of S&P sliding down are an element, but I would zoom out. It's been there, this theme of cautions and taking some chips off the table for the entire month. We've seen flows turning towards more defensive sectors in the US, industrial and utilities. In Europe, we've seen dividends, financials. The strongest month on record for small cap. So I think that this picture is really connected with the large decision that needs to be taken in the weeks to come.
Is it caution when it comes to US equities and taking chips off the table, or is it a signal that we've reached the top now, given the stretch valuations in tech, and specifically if a Fed decides that in fact September is not going to be the month in which they cut for the first time? Would that be the event that locks in a deeper downside for this equity market? How convinced are you that this is short-term, the selling that we've seen in the last few days?
I hear the question. Look, I think there's a lot to be considered, but if I take a step back, year to date, we have seen, as the year progressed, more attention and caution around tech. Month to date, we've seen outflows from the sectors. Prior 2 months, flat. May was again an outflow month. So we have seen chips being taken off the table. But Tom, it's been, in terms of magnitude, a very contained trend. And so for me, putting that in context with the fact that from a megaforce perspective, AI is still part of an industrial revolution that we're going to have to see playing out, continues to make the case going towards year end into an AI megaforce component within portfolios, together with US banks, for example, if we remain in that market. US healthcare we like. If I move into Europe, defence, if I think about European banks. So there's a theme there around selectivity and granularity, which means that whatever happens around these big events, and the one today and in 3-4 weeks being another one, will somehow be well absorbed by a diversified and defensively tilted portfolio.
Yeah. We were speaking to Karen Ward of JP Morgan earlier this week. She described, in terms of the rotation from US equities into European equities, there's been such a key theme in April and May. She says we're really actually only in the opening innings of that in terms of the flows that she's looking at. Do the flows that you're seeing on the ETF level, do they support that view that we're just in the early innings of that rotation from US into Europe?
I'm not sure. I would. So the first element that I would consider, that I would flag, is that rotation has been done by domestic investors. So purchases of European equities from US domiciled investors are very contained. European investors indeed have bought European equities this year 4.5 times with more conviction than what we had seen in 2024 at this point in the year. So there's definitely been a repatriation trend going on. But to your question, over the last couple of months, we've seen that somehow plateauing or slowing down. Again, we still like elements of the European market, banks, as I mentioned, being one. So I think there's still room to go, but it will be more of a selective, precise exposure purchase than an overall market entry, which is what we saw earlier in the year.
But before we let you go, your call on defence stocks in Europe, and that is one that it's certainly not counter consensus. But in an event where we get some kind of peace agreement between Ukraine and Russia, and the reporting in the last few days seems to suggest we are a long way from that. But in the event of that scenario, does that undermine the case for European defence, or is it immune to that because of the structural changes happening at the fiscal level?
We believe the latter. So again, if you take a step back and think about the great moderation ended with COVID and look at where we are now in terms of geopolitical fragmentations and tensions, I think you can make clearly the case of a paradigm shift in that sense. Commitment from the German government being a point in case. So obviously a ceasefire will be welcome and potentially have an impact in the short term. But in the long term, I stand by the call.
OK, Ursula, thank you very much indeed with the analysis on what to think about around the Fed and where to position and those flows as well into areas like US banks. AI as a mega trend continues and favouring defence stocks in Europe. Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions at Blackrock. More details on the Fed right now, because Fed officials are reportedly preparing to U-turn on their signature economic policy from 2020. The Wall Street Journal says Jerome Powell will use his Jackson Hole speech this afternoon to outline plans to move away from focusing on the risks of near zero interest rates and low prices, which prevailed, of course, when the policy was introduced back in 2020. Coming up, meanwhile, the EU and US outline plans that could cut tariffs on European cars and offer discounts on other goods. Wine and spirits, though, not yet part of the mix. It could all happen in the next few weeks. We'll get the details next. This is Bloomberg. Welcome back. Back to trade now. The US and EU outlining trade plans that could reduce tariffs on European cars to 15% within weeks and potentially offer discounts on steel and aluminium. White House trade advisor Peter Navarro credits the breakthrough in Ukraine talks for paving the way to the deal.
I can think of no deal more important than with the European Union. This is like a really important mountain to climb, and we climbed that. And President Trump got up to the top of the mountain today. In many ways, the Ukraine situation has been a total wake-up call for Europe.
Right, let's bring in then Bloomberg's trade czar Brendan Murray here and sitting on his own mount, and deservedly so as well. Brendan, what do we know? So we've been looking for additional details around this agreement that Europe and the US came to. The headline was 15% tariffs, but of course there was all the nuance, and you unpacked that for us in the weeks after that and the days after that announcement, of course. Now we have some more detail. How significant is it? What's been achieved?
It's incremental progress, I would characterize it. The Europeans got some clarity on the sectoral tariffs like semiconductors and autos, and so they have some understanding that those aren't going to stack on top of each other. There's the 15% is a ceiling, but as the European trade minister said yesterday, this is really the beginning of this process. These talks are going to go on for months and months. They still have a lot of issues to work out. The wine and spirits tariff at 15% is not pleasing the French or the U.S. industry. So there's still we did get some details, but there's still a lot of caveats in what we got in this joint statement yesterday. Not a whole lot of solid commitments.
Okay, so there's a lot of work still to go, and you'll have to wonder if this is a template for other trade agreements that are in the works. The headline deal, and then you work through the mechanics of the detail in the months that follow. In terms of the relationship between Brussels and Washington, that of course has been strained. How important is this in terms of putting a floor under that relationship? Yeah,
the other aspect of the deal was the investment pledges. These are the hundreds of billions of dollars worth of investment and purchases that the Europeans have pledged to make. Those are the kinds of things that President Trump asked them to do, and they followed through. Whether or not they actually materialize is a whole other question. But as Peter Navarro said, they made some progress, but they're still a long way from resetting and rebalancing the transatlantic trade relationship. There's a lot more work to do, and a lot of fine print left, which is really the hard work left to be done.
In other parts of the trading relationship emanating out of the US, de minimis, so these small, low-price packages entering the US, that had been significant if you're a Chinese e-commerce player shipping into the US market, and that rule was put in effect, and it affected companies like Shein. But there's a broader story here, and this is being rolled out further, and there's implications. Talk us through what's happening on the de minimis rule.
Absolutely. This is a really important story that we should keep an eye on in the week ahead. Next Friday, the de minimis exemption for duty-free treatment for goods under $800 that has applied to China and Hong Kong since May. Mm-hmm. That goes away for every country. So if you're sending a gift or a product from the UK, from Germany, from Japan, all these other countries, you're going to have to pay a tariff on it. You're going to have to calculate what that tariff is. And all these mail services around the world are suspending their shipments to the U.S. while they try to get a handle on what these new rules are. The customs duty has to be paid by the shipper. And so it's a really, it's a developing story. We're seeing these mail services, one after the other, come out and say, we don't have any clarity from the U.S. Customs Agency. And so it could disrupt shipping, an already disrupted global shipping industry to a significant degree until they get some clarity on this.
And if I'm sending a packet of Percy pigs to my relatives in LA, that's going to be hit with a tariff.
Well, there is an
exemption for
everything
Percy
under
Pigs.
100. Everything under 100.
Okay.
If you can verify that it's worth less than $100, you can send those to your relatives. But if you're an airline and you have a lot of cargo capacity in the cargo hold of passenger planes, a lot of goods destined for the U.S. over the next week are going to be impacted. So there's a real commercial and consumer element to this that we need to stay on top
Brendan,
of.
fantastic. Thank you very much for that update. Other suites, of course, are available. Bloomberg Trade Czar, Brendan Murray. 2 chips now, and Nvidia. Just the latest twist in the saga and the unfolding tale around semiconductors. Nvidia is lower in pre-market trading after reportedly instructing suppliers, including Samsung, to halt production of its H20 AI chip. Tech publication The Information says this comes after Beijing advised companies to steer clear over security concerns for the chip, which is built specifically for the Chinese market. Nvidia, for its part, has repeatedly denied that it added backdoors into that semiconductor. Bloomberg Intelligence analyst Rob Lee joins us now for the details and what this all means. What is the latest, Rob? What does it tell us about Nvidia's prospects in the Chinese market if indeed this reporting is confirmed?
Well, I guess in sort of British colloquial terms, this is the H20 hokey cokey, isn't it? We're one step in, one step out, in, out, then about shaking it about. But their strategy, their visibility on their H20 China business remains hugely uncertain. So prior to recent developments, it had been expected, following President Trump's decision to allow them to resume production, that production would likely start at the very tail end of this year at the earliest. So as I said, based on these unconfirmed reports, I should stress in the information, that is in disarray, or certainly it's certainly overshadowed by significant uncertainty at the moment.
And Rob, Jensen Huang is on the ground in Taiwan. He's been reflecting on some of this, and he's been stressing that there are no backdoors in these H20 chips.
Well, I guess you have to take what he says at face value, but from an engineering perspective, it's incredibly difficult to prove or disprove otherwise. Because first of all, if you did an examination of the hardware, as you appreciate, these chips are built at the atomic scale. So sure, you could take a very powerful scanning electron microscope, look at the structure in detail. But again, it's very difficult from a physical examination to make those sort of conclusions. And then equally, you would need access to the software that's running them, the firmware and other operating software, which it would be very difficult to access. So I would say, whilst the Chinese government has allegedly highlighted some concerns on that front, it's very difficult to disprove or prove. And equally, that echoes, if you remember, back to several years ago, where there were, again, unconfirmed allegations coming the other way that Huawei's technology had a similar backdoor, which is why I should say Huawei's telecoms equipment was stripped out of a lot of telephone exchanges and telecoms infrastructure from European countries, for example.
Yeah, a reminder that two can play at this game. Bloomberg Intelligence analyst Rob Lee, thank you very much indeed on the latest when it comes to Nvidia, the H20 chip and shipments into China. Staying with tech, Bloomberg understands Meta is hiring another key artificial intelligence executive from Apple, even as the social networking company prepares to slow its recruitment. We are told that Frank Chu, who has led Apple AI teams focused on cloud infrastructure, training and search, will be joining Meta Superintelligence Labs. Chu follows several of his colleagues to Meta, which has also hired the head of Apple's AI models team. And in a court filing, OpenAI says that Elon Musk identified Meta boss Mark Zuckerberg as one of the people he communicated with about financing a deal to purchase the maker of ChatGPT. OpenAI says, in the end, neither Zuck nor Meta participated in the $97 billion bid. The company's board formally rejected Musk's bid back in February. And Bloomberg understands Anthropic is nearing a deal to raise as much as $10 billion in a new round of funding. The fundraising is a higher than expected sum and one of the largest mega rounds to date for an artificial intelligence startup. Bloomberg has previously reported Anthropic was in advanced discussions to raise up to $5 billion in the round at a valuation of $170 billion. Coming up, the EU and US paved the way for lower tariffs on autos, pharma and chips. We're going to look at the implications for Europe and in particular the powerhouse of that Eurozone economy, at least on some measures, German industry, the impacts of this agreement, what it means for Germany and the relationship between Berlin and Beijing. That's coming up. This is Bloomberg. Good morning and welcome to the Pulse. I'm Tom McKenzie in London. Happy Friday. These are your top stories. The day of reckoning, markets cautious as traders await Jerome Powell's final Jackson Hole speech. But rate cut bets are trimmed after hawkish comments from Fed speakers. The EU and US outline plans to cut tariffs on cars, pharmaceuticals and chips within weeks. But there is still no deal on wine and spirits. Plus, Nvidia falls in pre-market trading after reportedly halting production of its made-for-China H20 chip after Beijing warned Chinese companies to avoid them. The US and EU have released details of a deal that lowers tariffs then on autos, pharmaceuticals, semiconductors and lumber to 15%. The announcement bringing some relief to Europe's manufacturing sector. Joining me now to discuss is Dalia Marin, Professor of International Economics at the Technical University of Munich, who has also been doing a deep dive on the relationship on a trading level between Germany and China. And we'll get to that shortly, Dalia. But I want to start on this agreement, at least filling out some of the details when it comes to the EU-US trade deal. How significant do you think that is? Some of the sectors getting some relief. Tariffs will be capped at 15%. What do you make of what we've been hearing out of Brussels and Washington in the last 24 hours?
So the major impact of this deal is that the German firms or the European firms now have more security what is going to happen in the near future, because before there was a zigzag policy with the tariffs and no firm knew what kind of trade policy will prevail. So planning was very difficult to do. So the major impact of this deal is that that firms have more security.
Yeah. Professor, do they have enough security now? Do they have enough certainty to be able to start increasing investments, to start putting money to work again in CapEx? Is that certainty now there for European firms?
Yes, there is more certainty. Full certainty is not there because you don't know whether this is not going to change in the future. So that's the new world we live in. But at least for now, they have more security. And I think firms will start to make decisions, because our research shows that when firms are faced with uncertainty, that has devastating effects on their decision, and firms have started to reshore production back to their home market because of this uncertainty. So I think it will help to keep globalization going.
And the importance of having that certainty, at least, was articulated, or at least put in the spotlight by the weaker than expected second quarter data, GDP data out of Germany. And on some analysis, that was because of some of that uncertainty, because of the tariff risk, because of what's happening in trade. When do you expect to see a convincing recovery in the German economy?
I think we can expect a convincing recovery in Germany. And the reason is that the government has decided to get rid of the debt brake and to start to spend, in particular to defense, and that will stimulate the economy. And on top of it, it will also help German economy to reorganize, because the auto sector and the machinery sector are under much pressure. And so some of this pressure will be relieved by going into defense. So this is going to happen in the future. So I'm pretty optimistic.
Okay. So that ties in nicely then to the analysis and the research you've been doing around the relationship between Germany and China. What are the most startling outcomes that have come about as a result of that that research in this around this central trading relationship, not just for the two countries, but for the world?
Yes, Europe is facing a deindustrialization shock worse than the US experienced in the 2000s when China entered the WTO. So Germany is particularly hit because its industrial structure are more similar to the Chinese. So in particular, the two core sectors of the German economy, namely cars and machinery, were particularly hit. In both sectors, Germany stopped to be a net exporter to China. In fact, in machinery, Germany got to be an exporter in 2015. And if you imagine that the machinery sector was the major part to industrialize the Chinese economy, this is particularly dramatic. Yeah. But also in the car industry, this is happening. Car exports to China dropped by 70%, and imports increased more than doubled. So this is a very dangerous situation in which these two sectors might migrate to China. So policymakers to act.
Okay, Professor, we appreciate your time. Dalia Marin, Professor of International Economics at the Technical University of Munich. We had some problems, of course, with the line there, but some analysis in terms of the relationship, the trading relationship, and how that's changed with 70% drop in terms of German exports of autos to China, and a reverse scenario with more Chinese cars being sold into the German market. And some of the prescription coming through from there from the Professor, including the call for more JVs and more state support, ultimately, for some of these key sectors in Germany and in Europe. Now, staying with Germany, there are memories, of course, still of hyperinflation, which kept investors on the sidelines for decades. The mood, though, is finally shifting. The stock market is booming, up around 20% year to date, and small investors are finally piling in. For more on what is driving the surge, I'm joined by Sagarika Jasingani, who is Bloomberg's deputy team leader for EMEA equities and investment strategy. Is Germany not known for mum-and-pop investors and retail investors, but that is starting to change?
Absolutely. Thank you for having me. You know, I was on the show earlier and I was saying that when you talk about what are the countries where the retail crowd is popular, Germany doesn't feature on that list, or it hasn't. And so when we got into the story, that was our, you know, the most telling thing for us, the number of retail investors that we were able to reach out to, the amount of data we were able to generate, that tells us this is actually a thing. And this is, you know, it's a significant trend that has taken hold among people who have traditionally been shy. They've been very risk averse, and fair enough, you have the psychological scars from the hyperinflation era, what they went through with the tech bubble popping in 2000, after 2000. So it's taken them a long time to come back into the market. But there is serious conversation happening now around the stock market is a buzzword, given the boom that we've seen in the DAX, not just this year, but the last 2 years as well. And at the same time, there is growing concern about, you know, when what happens to my pension. The current system is on a pay-as-you-go basis, which is that the current workers fund the pension for current retirees. So in an aging population, there's questions around how sustainable is that. So people are starting to say, I've got to take ownership of this now to secure my future tomorrow, and the stock market is a viable way to do that. Okay, so that's one of the catalysts, clearly, is what's happening with pensions in Germany and the run-up, of course, in German equities. What have you been hearing from some of the case studies, from some of the people you've been speaking to, and how sustainable do you think this trend is ultimately? I mean, if we get a sell-off, does that suddenly wash everyone out of the market and they say, you know what, that was a mistake? I mean, there are broader economic consequences to this. Absolutely. What we've heard from them, we've actually, we spoke to a range of them, starting from 19, 20-year-olds who are at uni, you know, discussing, swapping trading advice around the lunch table, right up to people who are nearing retirement, looking at this as I mean, everybody's looking at this as a serious thing. The stories were really fascinating. You know, we spoke to one, she's a mum-to-be, expecting her first child early next year. And she said that traditionally, when you have a baby in Germany, you open a bank account for them. Now I'm thinking I'm going to buy this baby, I start an ETF for this baby straight away. So that shows that this is actually a sustainable, fundamental shift in the way that they are thinking about it. And to your point about what happens if there is a sell-off, the data that we've seen is now consistent over 3 years. This is not a flash in the pan that, it's a month or a quarter out. There has been a steady increase to about near, the 20-year highs over the last 3 years. Comparatively, a survey from Blackrock across Europe showed that 3 million Germans have started buying stocks in the last 3 years, which is the second biggest increase after the UK. So this isn't something that is here today, gone tomorrow. OK, fantastic reporting on a shift, at least for now, in terms of Germany's investment intentions and mum-and-pop investors, retail investors getting involved. Sagarika Jaisingani, of course, implications for companies wanting to raise capital and for the growth prospects of Germany as well. You can get that reporting, of course, on Bloomberg.com and on the terminal. Back to the Fed now. Kansas City Fed President Jeffrey Schmidt says American businesses are showing renewed optimism that is filtering through to the labour market and putting the focus back on inflation. Schmidt spoke with us from Jackson Hole about the economy and growing political pressure on the Fed.
I'm a little philosophical about the whole conversation of Fed independence and where our role is in the American economy. We're almost 250 years old as a nation. I think there's something to be said. We were built on words, and we continue to debate those words legislatively and judicially. Whatever friction we might have with other branches of the government, I think great steel's tested by fire. So we can always be better. We can always do this better. But I think the nature of independence and I think, don't believe me, believe other nations that have central banks and don't. It seems to work, but I'm always open for the conversation of how do we make it better.
Well, the big question for everybody, especially for Wall Street, is what happens on September 17th?
So this is, as you know, kind of an interesting month because we've got Jackson Hole and then we've got quite a few weeks of data to kind of pull in. So I'm really, I think everybody's quite interested in some of maybe the prints that happened in the last couple months and kind of where they go from here. So I'm like everybody. I think there was some fascinating conversations at the last FOMC. As you know, there were a couple of dissents. I think my interpretation of what's happening, especially in the labor market, is that the first couple quarters, a lot of business people were just saying there's uncertainty enough, and I think they kind of cooled a little bit on the higher side. But the most recent couple weeks that we've been talking to businesses in the district, there seems to be a burgeoning optimism again, that they've kind of digested and they've been agile enough to try to work their way through some of the new policies from the administration, and maybe going forward, maybe we'll see a little bit of uptick. That said, I still believe that the inflation number is trending closer to 3 than 2.
Well, we saw that in the minutes that, in general, the Open Market Committee felt that inflation was a bigger danger at this point. Would you say that's your view now?
It would be my view now. I think with an understanding that what may have happened in the first couple quarters on the labor side, which I think concerned several people were on the committee, me included. But I think this PPI was interesting, that print was interesting, but I really believe that when we talk to a lot of folks in our district, is that if you had to kind of lean or have a bias toward, it would be on the inflation side.
Kansas City Fed President Jeffrey Schmidt speaking with Bloomberg's Michael McKee, of course, at Jackson Hole. Now, some other stories making the news this Friday. The UK's tax authority tightening up scrutiny on pensions relief claimed by higher earners. This, according to the Financial Times and the Telegraph. The moves include a clampdown on claims made on the phone and stricter checks, for example, asking for evidence when it may previously not have been required. According to the reports, a review by the tax office found around a third of claims under £10,000 were incorrect. And the UK government says it will buy 6 new land scepter systems from multinational European arms maker MBDA over 3 years in a deal worth £118 million. They include so-called anti-air modular missiles capable of hitting a tennis ball-sized object travelling at twice the speed of sound, as well as launchers and support vehicles. And shares of WH Smith slumped 42%, the most on record, after the discovery of an accounting error forced it to slash its profit outlook in North America. It is a major setback in a key growth market for the British retailer. A financial review found an overstatement of about £30 million in expected headline trading profit for North America this financial year. The error came after it booked income from suppliers earlier than it should have. Coming up, the pivot from babies to boomers. How consumer companies are reassessing their customer base amid falling birth rates and ageing populations. That story is next. This is Bloomberg. Welcome back. Now, South African retailer Spar is reshaping its growth strategy. Both its UK and Swiss businesses are up for sale as it looks to focus on its core African and Irish operations. Bloomberg's Jennifer Zabasaja sat down with the company's CEO, Angelo Swartz, to talk about the company's restructuring.
South Africa has more retail space per capita than most emerging markets. With more than 1,400 shopping malls dotted across the country, retail is big business. And in the hunt for growth, many companies have looked to overseas expansion. The Spar Group is one example. Just over a decade ago, the company acquired licenses to operate Spar-branded shops in countries including the UK, Ireland, Switzerland, and Sri Lanka. I met the CEO, Angelo Swartz, at Spar's Durban headquarters. He told me local investment restrictions were part of that motivation.
I think that idea was driven primarily by South African legislation, which limited investment managers from investing too big a part of their portfolio out of South Africa. And therefore, many investment managers were really looking for South African companies to be proxies in other markets.
Spar is largely a wholesale business. In the UK, for example, over 300 independently owned shops all carry the same brand. They benefit from centralized marketing and distribution. In exchange, the Spar Group collects fees and leverages purchasing power with suppliers. But in recent years, its African revenue has far outpaced what it gets from Europe. Take Switzerland, a country with strong trade protection measures. Groceries there are often 50% more expensive than in its European neighbors. When Swartz took over as CEO just 2 years ago, he decided to divest the Swiss and UK businesses, materially strengthening the balance sheet.
When we looked at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced.
Retail analyst Alec Abraham argues Spar's biggest mistake was taking its eyes off South Africa.
When you go into a new country, there's a very different operating environment, and you need to be focused to understand that market and to succeed in that market.
Back home, Spar is expanding its DIY and pharmacy businesses and is building out its liquor operations.
And I think with Spar being where it is and how competitive the South African market is, we really just want to refocus on our home markets.
That's because liquor shops in South Africa are expanding fast. Last year, they grew almost twice as quickly in the country as conventional supermarkets.
Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country.
Spar's CEO has branded this battle for shoppers as South Africa's wine wars, a high-margin, high-growth area in an otherwise struggling consumer market.
We have shown that our business has the ability, and our independent retailers have the ability to compete directly with the chains, empowered by us. And we are now the second biggest supermarket brand in this country, which is no mean feat.
Having sparred with what today are smaller supermarket rivals, Swartz may soon be ready to take on #1 ShopRite in what could be his toughest fight yet.
And for a deeper dive, catch our TV show Next Africa, airing on TV on the last Friday of every month. You can watch our previous episodes in full on your terminal, on our website, and of course on YouTube. Now, something a little bit different. Shrinking birth rates have many consumer companies worried, but they may be looking the wrong way. The real growth isn't in babies, it's in baby boomers, with older adults now holding more spending power than younger generations. Andrea Felsted from Bloomberg Opinion joins us now on why companies need to rethink who they are selling to. Why, then, Andrea, should companies start to pay a bit more attention to the silver economy, the grey-haired economy?
Exactly. Well, birth rates are shrinking. We have more older people. We're living longer, albeit gains are slowing. That gives a big market, and they have lots of money. There's quite a lot of wealth concentrated in older generations. Although their incomes tend to shrink as they get older, they have a lot of assets, and they typically like to spend that on travel and services. But increasingly, they're going to want products and also need products.
For example, I mean, what kind of things could these companies look to do in terms of switching for the products? I mean, now for kids and babies to the elderly.
The most successful one has been nappies to incontinence care, which is growing very quickly. But nutrition is another real opportunity with less infants. But there's a lot of the technology that we need to feed babies. You know, you need specialist nutrition. It's a highly regulated market. You can put that to older people. As we age, our appetites shrink, but we need more nutrients. That means very densely packed food, and it helps that protein is a big obsession with GLP-1. But that could pave the way for these specialist foods for older people. Toys is another thing that, you know, the toy market will shrink as there are few children, but if you they're already catering to adults. But if you go up the age range, you've got older adults. And one of the most fascinating things was these sort of animatronic pets that are really successful with the elderly. They respond to touch and
Are these
sound.
These kind of pillows that move and have little robots?
No, they're actually like lifelike cats and dogs. And as a cat owner, they're very realistic because the cat doesn't always respond to you, whereas the dog nearly always
So just to project into the future, I'm looking at a world where I'm being fed some protein slop, I'm sitting in an incontinent pad, and I'm playing with an electronic cat. Is that my future?
That's your future, but that's very good for consumer companies because it might not be you buying the product. It might be, you know, it could be even worse. You could be in a care home, so the care home or the facility is buying it for you. So that's another big market. It's another big area to tap into.
Okay, Andrew, you have not reassured me. But changing demographics is real.
Yeah.
What other things could companies, and are companies looking at doing around the changing demographics?
They definitely are. One of the most interesting things is this idea of living for longevity. We all know we're going to live longer, so we start preparing for that in our younger days. So obviously skincare is one of the things most obvious, but vitamins and minerals, there's a lot of research being done into supplements that can help prepare you for your older days. So it's not just about catering to people when they're very old, it's preparing, it's helping people prepare throughout their lives.
Yeah, longevity is such a massive theme, isn't it?
Exactly.
That's the part I like. I like that part, Andrea. No, it's great reporting. Some of it's very counterintuitive, and it's the Bloomberg Opinion piece, of course, that you should read this weekend. Andrea Felsted, Bloomberg Opinion columnist, of course, and you can find that on Bloomberg.com and, of course, on the terminal. Let's segue back to the markets right now, shall we? And check in on US futures. Of course, traders are girding themselves for the speech out of Jackson Hole from Jay Powell. US futures pointing high by 0.2% after 5 straight days of losses. And, of course, markets and traders have paired those bets on that September cut and the prospects of a September cut now just at around 70%, when just over a week ago you were pricing an almost 100% chance of a September cut. The Fed speakers we've heard from in the last 24 hours or so have been a little bit more cautious in terms of the signalling around this. What will Jay Powell say ultimately? Will he validate the concerns about the labour market, or push back on some of these bets that we're seeing. Nasdaq 100 futures also pointing a little higher, up a 0.1%, despite the concern around Nvidia, the pre-market pressure on that company on the back of the H20, the H20 story into China. We're going to have full coverage, of course, of Jackson Hole, the economic symposium, including interviews with current and former Fed presidents. It starts at 2 p.m. London time. You need to tune in for this. And then, of course, the big event. Drum roll. Jerome Powell speaking at 3 p.m. UK time for this last time at Jackson Hole in his current role. This will be his last symposium, of course, as Fed chair. Stay with us for all of that. Up next, Bloomberg Brief. This is Bloomberg.